Chairman Teaberry, Ranking Member Heinrich, and members of the committee, I appreciate the opportunity to testify before you today. I will discuss the current economic outlook and monetary policy. The U.S. economy has strengthened further this year. Smoothing through the volatility caused by the recent hurricanes, job gains averaged about 170,000 per month from January through October, a somewhat slower pace than last year, but still above the range that we estimate will be consistent with absorbing new entrants to the labor force in coming years. With the job gains this year, 17 million more Americans are employed now than 8 years ago. Meanwhile, the unemployment rate, which stood at 4.1% in October, has fallen 0.6 percentage points since the turn of the year and is nearly 6 percentage points below its peak in 2010. In addition, the labor force participation rate has changed little on net in recent years, which is another indication of improving conditions in the labor market, given the downward pressure on the participation rate associated with an aging population. However, despite these labor market gains, wage growth has remained relatively modest. Unemployment rates for African Americans and Hispanics, which tend to be more sensitive to overall economic conditions than those for whites, have moved down on net over the past year and are now near levels last seen before the recession. That said, it remains the case that unemployment rates for these minority groups are noticeably higher than for the nation overall. Meanwhile, economic growth appears to have stepped up from its subdued pace early in the year. After having risen at an annual rate of just 1.25% in the first quarter, U.S. inflation-adjusted gross domestic product is currently estimated to have increased at a 3% pace in both the second and third quarters, despite the disruptions to economic activity in the third quarter caused by recent hurricanes. Moreover, the economic expansion is increasingly broad-based across sectors as well as across much of the global economy. I expect that with gradual adjustments in the stance of monetary policy, the economy will continue to expand and the job market will strengthen somewhat further, supporting faster growth in wages and incomes. Although asset valuations are high by historical standards, overall vulnerabilities in the financial sector appear moderate, as the banking system is well capitalized and broad measures of leverage and credit growth remain contained. Even with the step up in growth of economic activity and a stronger labor market, inflation has continued to run below the 2% rate that the Federal Open Market Committee judges most consistent with our congressional mandate to foster both maximum employment and price stability. Increases in gasoline prices in the aftermath of the hurricanes temporarily pushed up measures of overall consumer price inflation, but inflation for items other than food and energy has remained surprisingly subdued. The total price index for personal consumption expenditures increased 1.6% over the 12 months ending in September, while the core price index, which excludes energy and food prices, rose just 1.3% over the same period, about a half percentage point slower than a year earlier. In my view, the recent lower readings on inflation likely reflect transitory factors. As these transitory factors fade, I anticipate that inflation will stabilize around 2% over the medium term. However, it is also possible that this year's low inflation could reflect something more persistent. Indeed, inflation has been below the committee's 2% objective for most of the past 5 years. Against this backdrop, the FOMC has indicated that it intends to carefully monitor actual and expected progress toward our inflation goal. Although the economy and the jobs market are generally quite strong, real GDP growth has been disappointingly slow during this expansion relative to earlier decades. One key reason for this slowdown has been the retirement of the older members of the baby boom generation, and hence the slower growth of the labor force. Another key reason has been the unusually sluggish pace of productivity growth in recent years. To generate a sustained boost in economic growth without causing inflation that is too high, we will need to address those underlying causes. In this regard, the Congress might consider policies that encourage business investment and capital formation, improve the nation's infrastructure, raise the quality of our educational system, and support innovation and the adoption of new technologies. I will now turn to the implications of recent economic developments and the outlook for monetary policy. With ongoing strengthening in labor market conditions and an outlook for inflation to return to 2% over the next couple of years, the FOMC has continued to gradually reduce policy accommodation. The committee raised the target range for the federal funds rate by 1/4 percentage point at both our March and June meetings, with the range now standing at 1 to 1.25%. And in October, the committee began its balance sheet normalization program, which will gradually and predictably reduce our securities holdings. The committee set limits on the pace of balance sheet reduction. Those limits should guard against outsized moves in interest rates and other potential market strains. Indeed, there has been little, if any, market effect associated with the balance sheet runoff to date. We do not foresee a need to alter the balance sheet program, but as we said in June, we would be prepared to resume reinvestments if a material deterioration in the economic outlook were to warrant a sizable reduction in the federal funds rate. Changes to the target range for the federal funds rate will continue to be the committee's primary means of adjusting the stance of monetary policy. At our meeting earlier this month, we decided to maintain the existing target range for the federal funds rate. We continue to expect that gradual increases in the federal funds rate will be appropriate to sustain a healthy labor market and stabilize inflation around the FOMC's 2% objective. That expectation is based on the view that the current level of the federal funds rate remains somewhat below its neutral level. That is, the rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel. The neutral rate currently appears to be quite low by historical standards, implying that the federal funds rate would not have to rise much further to get to a neutral policy stance. If the neutral level rises somewhat over time, as most FOMC participants expect, additional gradual rate hikes would likely be appropriate over the next few years to sustain the economic expansion. Of course, policy is not on a preset course. The appropriate path for the federal funds rate will depend on the economic outlook as informed by incoming data. The committee has noted that it will carefully monitor actual and expected inflation developments relative to its symmetric inflation goal. More generally, in determining the timing and size of future interest rate adjustments, the committee will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. Thank you. I would be pleased to answer your questions.